Welcome to Houselux Estate, your go-to source for all things investment. Today we are focusing on the strategies for investing in mutual funds. For those who might not be in the know, mutual funds are a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities, which are managed by professional fund managers. They offer diversification and professional management, but come with their own set of risks and rewards. So, why mutual funds? They provide an opportunity for small or individual investors access to professionally managed, diversified portfolios of equities, bonds, and other securities, which would be quite difficult to create with a small amount of capital. The aim of this video is to guide beginners on how to navigate this investment landscape. We'll be sharing proven strategies, tips, and tricks to help you make the most of your mutual fund investments. So stick around as we delve into the best strategies for investing in mutual funds. To start off, it's essential to understand what mutual funds are. Imagine a giant pot of money where each person contributes a portion. This pot is then used to invest in a variety of stocks, bonds, or other securities. This collective investment is what we call a mutual fund. Now, what makes mutual funds so appealing? Well, for one, they offer diversification. Because mutual funds invest in a large number of securities, the risk associated with them is spread out. Think of it as not putting all your eggs in one basket. Secondly, mutual funds are managed by professionals. These individuals or teams have extensive experience and knowledge in the field of investment. They're the ones who decide where to invest the money in the fund. Their expertise can potentially lead to higher returns than if you were to invest on your own. But, as with any investment, mutual funds come with their own set of risks. The value of your investment can go down as well as up, depending on the performance of the securities in the fund. Also, while professional management can be a boon, it also means you have less control over your investment. Plus, there are fees associated with mutual funds which can eat into your returns. It's also worth noting that not all mutual funds are created equal. There are different types, each with its own risk and return profile. Some may focus on stocks, others on bonds, and some may even invest in a mix of both. The key is to choose a mutual fund that aligns with your financial goals and risk tolerance. And there you have it, a basic rundown of what mutual funds are. They offer a way for investors to gain exposure to a wide range of securities managed by professionals and with the benefit of diversification. But they also come with their own risks and fees. Now that you have an understanding of what mutual funds are, let's move on to the strategies involved in investing in them. First up on our list of strategies is diversification. Now, what is diversification, you might ask? Simply put, diversification is the practice of spreading your investments across various types of assets to reduce risk. Picture a farmer planting different types of crops in his field. If a disease wipes out one crop, the others remain to ensure the farmer still has a harvest. In the context of mutual funds, diversification is achieved by investing in a mix of different types of securities. These could be stocks, bonds, or other types of investments from different industries and markets. This way, if one sector or market takes a hit, others may perform well and offset the losses, ensuring that your overall portfolio remains relatively stable. Now, let's talk about the benefits of diversification. The primary benefit is risk reduction. As we've just discussed, investing in a variety of assets can help cushion the blow if one or more of your investments perform poorly. It's a bit like not putting all your eggs in one basket. Another benefit of diversification is the potential for higher returns. While some investments may be riskier than others, they may also offer higher potential returns. By diversifying, you can balance your portfolio between high-risk, high-return investments and lower-risk, lower-return investments. Increased potential for steady growth is another advantage of diversification. Since different types of investments tend to perform well at different times, having a diversified portfolio can provide more consistent returns over time. Finally, diversification also offers the benefit of flexibility. As your financial goals and risk tolerance change over time, a diversified portfolio allows you to adjust your investments accordingly without drastically altering your overall strategy. To sum it up, diversification is all about balance. It's about spreading risk across different types of investments to maintain steadiness in your portfolio, even during volatile market conditions. It's about finding the right mix of investments that aligns with your financial goals and risk tolerance. Diversification, as you see, can be a powerful tool in your mutual fund investment strategy. Next up, we have a strategy known as dollar cost averaging. Now, this might sound a bit technical, but don't worry, it's simpler than you might think. So what is dollar cost averaging? In essence, it's a technique that involves investing a fixed amount of money at regular intervals, regardless of the price of the investment. In the context of mutual funds, this could mean investing a set amount every month, every quarter, or even every year. The key is consistency. Now, why is this beneficial, specifically for beginner investors? Well, there are a few reasons. Firstly, it's a disciplined approach, which helps to take the guesswork out of investing. You don't have to worry about trying to time the market or make predictions about when prices will rise or fall. Instead, you simply invest a fixed amount on a regular schedule. Secondly, dollar cost averaging can help to mitigate risk. Here's how it works. When you invest the same amount of money consistently, you buy more shares of a mutual fund when prices are low and fewer shares when prices are high. Over time, this can result in a lower average cost per share compared to trying to time the market. Thirdly, dollar cost averaging can be a more manageable strategy for those with a limited budget. Instead of trying to save up a large lump sum to invest, you can start with smaller, regular investments. This can make getting started with investing more accessible and less intimidating for beginners. But remember, like any investment strategy, dollar cost averaging doesn't guarantee success, and it's important to do your own research and consider your own financial circumstances and goals. That being said, dollar cost averaging can offer a structured and systematic approach to investing in mutual funds. It can help you navigate the ups and downs of the market, making it an excellent strategy for beginners. It's like setting your investment journey on cruise control, allowing you to ride out the market's waves with a little more peace of mind. Dollar cost averaging can help you navigate the ups and downs of the market, making it an excellent strategy for beginners. The last strategy we will discuss today is regular monitoring and rebalancing. Just like a well-tuned machine, your mutual fund portfolio requires regular checkups to ensure it continues to run smoothly. This is where the concept of regular monitoring comes into play. By keeping a close eye on your investments, you can identify any changes in the market or in the performance of your funds. Think of it as a health checkup for your portfolio. It's not about obsessing over daily fluctuations, but rather about understanding the broader trends. Are your funds performing as expected? Have there been significant changes in the market that might impact your investments? These are the kinds of questions you should be asking yourself during these checkups. Now let's talk about rebalancing. Rebalancing is all about maintaining the balance of your portfolio in line with your investment goals. You see, over time, some of your investments may grow faster than others, causing your portfolio to veer off its intended path. When this happens, you need to rebalance. Rebalancing involves selling off some of the investments that have grown disproportionately and buying more of those that haven't grown as much. This might seem counterintuitive at first. Why would you sell off your best performing investments? But remember, the goal here isn't to chase short-term gains, but to stick to your long-term investment strategy. And that's the real beauty of rebalancing. It forces you to stick to your plan, to buy low and sell high. It's a disciplined approach to investing that can help you weather the ups and downs of the market. Of course, rebalancing should be done thoughtfully and not too frequently. Some investors find it helpful to set a specific threshold, say a 10% deviation from their target allocation, as a trigger for rebalancing. Regular monitoring and rebalancing are crucial to ensuring your investment stays on track. So there you have it, the best strategies for investing in mutual funds for beginners. We've walked through the essentials of understanding mutual funds, the importance of diversification, the benefits of dollar cost averaging, and how regular monitoring and rebalancing can help optimize your investments. It's crucial to remember that knowledge is your first investment. Understanding these strategies is like having a compass in the financial wilderness. It guides your decisions, helping you navigate the ups and downs of the market. Diversification helps you spread your risks and potentially increase your returns. Dollar cost averaging, on the other hand, allows you to invest regularly, taking advantage of price fluctuations over time. Regular monitoring and rebalancing keep your portfolio in check, ensuring it aligns with your investment goals. With these strategies in your arsenal, you're well equipped to venture into the exciting world of mutual funds. Thank you for watching, and don't forget to subscribe to Houselux Estate for more insightful investment tips. Happy investing!